To talk about Cathie Wood's perspective about recession this year, we will be joined by Yahoo Finance's Alexandra Semenova. Yahoo Finance is a popular financial news and data platform that provides a wide range of information related to stocks, investments, currencies, commodities, and general financial news. So, as reported by Alex Semenova for the Cathie Beat, she said that Cathie Wood announced that the U.S. economy has already entered a recession.
Cathie Wood, the Ark founder and CEO, said Monday in an interview with Bloomberg that the U.S. economy has already entered a recession and that we'll be coming out of it next year. She pointed to 2 consecutive quarters of negative GDP and 3 months of declines in leading indicators to suggest we're already in an official economic downturn.
In the video, we see that Cathie Wood, a prominent investor, has shared her belief that the United States economy has entered a recession. Well, if Cathie Wood says the U.S. economy is in a recession, maybe we should start investing in couches, 'cause we'll all be spending more time on them. Just kidding. Anyways, Wood's analysis is based on crucial economic indicators, such as the gross domestic product and leading indicators, which provide insights into the state of the economy. To better understand her perspective, we will delve into the concept of a recession, the significance of GDP, declines in leading indicators, and provide real-world examples to illustrate these concepts. A recession is a period of economic decline characterized by a significant slowdown in economic activity. It often involves negative growth in GDP, a contraction in business activity, and increased unemployment rates. Economists generally define a recession as 2 consecutive quarters of negative GDP growth. Simply put, it means that the overall production of goods and services within the economy is shrinking, leading to reduced economic output. It's like when you order a large pizza, but all you end up with is a single sad slice. Definitely not what I'd call a fruitful economic feast. Moreover, gross domestic product, or GDP, serves as a key economic indicator that measures the total value of all goods and services produced within a country over a specific period. It provides insights into the size and growth of an economy and is widely used to assess its overall health. GDP is calculated by summing up the value of consumer spending, government spending, investment, and net exports, exports minus imports. To illustrate the concept of GDP, let's consider an imaginary country called Prospera. In Prospera, the main economic activities are agriculture, manufacturing, and services. Suppose in a given year, the country produces $100 million worth of agricultural goods, $200 million worth of manufactured goods, and $300 million worth of services. The total GDP of Prospera would be $600 million. Leading indicators are economic metrics that tend to precede changes in the overall economy. They are used to forecast future economic trends and are closely monitored by analysts and policymakers. Examples of leading indicators include stock market performance, consumer confidence, housing starts, and business investment. Declines in leading indicators can act as warning signs of an impending recession. For instance, a decrease in consumer spending, declining business investments, or a significant drop in the stock market could signal a weakening economy, a sure sign that the economy is doing its best impression of a deflating balloon. These declines indicate a potential deterioration in the overall economic health and point towards an economic downturn. To better understand how declines in leading indicators can foreshadow an economic downturn, let's examine 2 hypothetical scenarios. Consumer spending. Suppose there is a significant decline in consumer spending, with people cutting back on non-essential purchases and reducing overall consumption. This could be due to factors such as rising unemployment, reduced disposable income, or general economic uncertainty. As consumer spending decreases, businesses experience a decline in revenue, leading to reduced production and potentially job losses. This decline in consumer spending serves as a leading indicator, suggesting an economic downturn may be imminent. Stock market performance. If there is a substantial drop in stock market indices, it indicates a loss of investor confidence in the economy. Stock market performance is often influenced by factors such as corporate earnings, investor sentiment, and global economic conditions. A prolonged downward trend in the stock market may indicate a lack of optimism regarding future economic prospects, leading to a potential recession. Cathie Wood's perspective on the U.S. economy aligns with her analysis of the GDP and declines in leading indicators. And note, folks, these things I'm saying now about recession are actually happening as of this moment. Firstly, there has been a noticeable contraction in the U.S. GDP. Economic data reveals that the country experienced negative GDP growth for 2 consecutive quarters, meeting the criteria for a recession. For instance, the GDP for the first quarter of the year contracted by 1.3% and continued to decline by 0.7% in the following quarter. This decline indicates a contraction in economic output and aligns with Wood's assertion. Furthermore, declines in leading indicators have been observed, further reinforcing the notion of a recession. Consumer spending, a crucial driver of economic activity, has seen a notable decrease. As the COVID-19 pandemic persists, many individuals have reduced their discretionary spending, resulting in decreased revenue for businesses across various sectors. I guess we'll have to settle for window shopping and dreams of luxury yachts for now. Yikes! This decline in consumer spending serves as a leading indicator, supporting the notion of an economic downturn. We cannot also deny the fact that there had been rising unemployment rates. As businesses face financial challenges during a recession, many have resorted to cost-cutting measures, including layoffs and furloughs. This has led to a surge in unemployment, with millions of individuals losing their jobs. Looks like the job market is playing a cruel game of musical chairs, but unfortunately, it's the workers who are left standing without a seat. Better start brushing up on those impressive circus tricks for the next interview. But yeah, the increase in unemployment rates reinforces the notion of an ongoing recession and underscores the challenges faced by the labor market. With all the things that's happening, specifically on recessions, Ark Invest, an investment management firm founded by Cathie Wood, expects that the Federal Reserve will, quote, usher in rate cuts next year.
Ark Invest also expects the Federal Reserve will, quote, usher in rate cuts next year. Ark Invest's family of actively managed ETFs have been hit particularly hard by this year's sell-off in tech stocks, which many have tied to rising interest rates.
When it comes to managing the economy, the Federal Reserve has a range of tools at its disposal, including interest rate adjustments. One of the primary ways the Federal Reserve influences the economy is by changing the federal funds rate, which is the interest rate at which banks lend funds to each other overnight. By raising or lowering this rate, the Federal Reserve aims to stimulate or cool down economic activity. Rate cuts by the Federal Reserve typically occur during periods of economic downturn or when the central bank seeks to stimulate economic growth. When the economy is facing challenges, such as a recession or sluggish growth, the Federal Reserve may lower interest rates to encourage borrowing and spending. Lower interest rates make it cheaper for businesses and consumers to borrow money, thereby stimulating investment, consumption, and overall economic activity. Just as Cathie Wood and Ark Invest focus on disruptive technologies and transformative ideas, we can embrace this mindset in our own lives. During challenging times, we can explore new avenues, seek out innovative solutions, and adapt to changing circumstances. What do you think about this topic? Let me know in the comments section below. Don't forget to like, share, and subscribe to Finance Zoom channel.